Hi, I'm Jerry Slusowitz. Welcome to another one of our Money Talks videocasts. We're here to talk about the markets, talk about your money, try to help you gain a perspective of what we're looking at with our 25 years of professional money management experience, both technically and fundamentally looking at the markets and trying to determine what's going to happen next. Well, to do that, you kind of got to look at what's just kind of transpired. Second half of the year, we saw a series of lower highs and higher lows, and that kind of ended up in a breakout condition at the end of December. But really, we were kind of at that low point, on the last low point at the very end of November, around 1158 on the S&P 500. We use the S&P 500 because it's 500 companies versus the Dow 30 that a lot of people talk about, but that's not truly a reflection of the overall market. So since that 1158 to today, January 17th, 2012, so just, less than 2 months, market's gone up around 12% in that time frame, where we touched 1300 this morning. We did break above the highs from that cycle, from August low through the second half of the year today. Both the Dow, Nasdaq, S&P, they look like they're for sure going to run all the way back to last year's high set in late April, early May 2011. But with that said, is that the next move? After 11.5%, almost a straight up run for the last almost 2 months, and investor sentiment going from overly bearish to now very overly bullish and hardly any bears. The recent AAII, American Association of Individual Investors, came in with only 17% bears looking forward over the next 6 months, and over 50% bulls. That is historically a wide margin, and it's historically a low bearish sentiment. Generally speaking, we're probably overdue for some sort of a pullback. The news have been pretty negative. I mean, things in Europe have not been resolved yet. They did, as I put on the last video cast, come out with a new type of what's called the LTRO, long-term, whatever it was, refinancing operation. They're allowing the banks in Europe to buy sovereign debt and borrow at 1% and make money on that spread. That was a 600 trillion operation in January. The next operation is going to be late February. They're expecting it to be over €1 trillion, which is significantly more, like 1.3, 1.4 US dollars. It's a lot of money that the European Union Central Bank, ECB, is printing to bail out Europe, or at least delay and kick the can down the road. So, fundamentally, technically, things are doing okay and seem to be breaking out to the upside. I do think that the old highs of last year, the 1365 range, somewhere in that, is definitely going to be tested, and if not only tested, but broken to the upside. But probably get a little pullback, maybe around 4%, to somewhere around from 1297, approximately where we are today, or to maybe around 1250. That's not a huge percentage, but that's probably going to take a little delay in this constant march upward and forward. But with that said, we're pretty bullish. Use maybe some of the hedging inverse ETFs to protect your long positions. Use stop losses on every single position you own. If you don't have stop losses, you need to figure out some sort of an exit strategy on an absolute basis. And if you don't know what that means, call me, Jerry Slusowitz, 800-449-9501, or on the web at www.yourmoneytalks.com. We are looking at investments that make money, that pay income, but at the same time, you must protect your capital. Call it the CPR method. Control your cost, protect each position to reduce your risk, the CPR method. And that is having the plan for the positive outcome, but also a defensive mechanism, an exit strategy in case things don't work the way you want them to. But we're very optimistic going forward. However, in the near term, after this great run-up, we expect the next move or the next week to maybe be a little bit of a pullback. Nothing too significant, but nothing to lose, nothing to stop watching the market. You got to watch it very closely in case this turns into something more significant and we go back all the way down to that 1158 that I was talking about, the November breakout number. That would be a significant drop from here. We don't want that to happen. Okay, stay tuned next week for another edition of Money Talks video with me, Jerry Slewsowitz, right here. Thank you.